You shall not pass. Gandalf said that, and in this market it still rings true. Bitcoin's 80,000 level is a psychological level, acting like a roadblock to its recovery. Ether can get past 2.4k. The Persian Gulf, the Strait of Hormuz, is still closed, meaning oil, gas, fertilizers, helium. Nothing is flowing, and there is still no peace agreement on the horizon. Yet somehow, TradFi is rallying. So what does that mean for crypto? Let's find out. I'm Igor, investment director at Venionaire Capital, your entrepreneurial partner, and this is Crypto Insights. April was a strong month for US-based Spot Bitcoin ETF flows. Monthly net inflows landed at $2 billion, making a very constructive buy flow in total. However, in just the first 2 days of May, the 1st of May and the 4th of May, net inflows already total 1.16 billion. So in just 2 days, we have over 50% of the entire April's net inflow and almost the entire March net inflow of 1.32 billion, if I'm not mistaken. So this is very nice, actually. Ether, on the other hand, got a moderate plus 356 million. So it is still fighting the good fight. So Ether, keep it up. Now, besides spot ETFs, there is another major buyer that has been significantly influencing Bitcoin's price action. Of course, Mr. Saylor, using two of his vehicles, STRC and MSTR, has been busy buying. He buys at market using TWAP as soon as he raises funds. Past few weeks of Bitcoin price action have been actually supported by his signature buying, I would say. His goal is to accumulate a total of 1 million bitcoins by the end of this year. Mr. Saylor is already sitting on over 818,000 bitcoins, which leaves some roughly 82,000 bitcoins still to buy. Since the start of this year, he has already purchased almost 146,000 bitcoins. In April alone, in the last month, he bought over 56,000. So some of you might ask, so what? The Bitcoin issuance is around 13,500 Bitcoins per month. You can now easily see where this is going, right? Last week, Saylor paused and announced he would continue buying this week. So since last Thursday, Bitcoin has been on a good run. It seems as the market is front-running Saylor's announced shopping spree for this week. His purchases can only continue as long as he keeps raising funds. But Saylor and the ETF buyers are not the only ones who are active in this market, of course. On the other side of the trade transaction, there is meaningful selling pressure. Miners are still selling their Bitcoin production, and BTC hash rate is still falling, indicating that miners are shutting down their grid, their infrastructure, and or are migrating to AI compute. Here in this chart, we can see that miners are at their cost of production, shown by the lower dotted orange line. That cost basis, when multiplied by 1.2, gives us the upper thinner orange line. So historically, this production channel has acted as a support area during bear markets with only short-term price deviations below it. And there is another source of potential selling pressure worth watching, I would say. Anyone who bought Bitcoin on the way down now gets the chance to exit at break-even. Saylor selling his BTC stack is not an option, I would say, which leaves us with spot ETF buyers and some old whales, let's say. So what is their cost basis of ETF buyers? On this chart, we can see the spot ETF cost basis, which sits around 82,000 US dollars. For any spot ETF holders who have been underwater since early this year, they now get a chance to exit. This translates into added selling pressure that could potentially roadblock higher prices, specifically the 85 to 93,000 US dollars as a range, as mentioned, at least in the interim, I would say. So BlackRock's IBIT is heavily influencing the Bitcoin price and can, realistically speaking, pull it down despite Saylor buying, and to some extent also vice versa. So we have strong buyers on one side and meaningful selling pressure on the other. This is precisely the tension that is playing out in the charts right now that we can observe. So before we dive into the charts, let's quickly set the macro context. Nasdaq is still riding the AI wave, as is the S&P 500, despite no improvement in the overall geopolitical conditions surrounding energy supply, and despite having just printed the new all-time highs as well. So Nasdaq's momentum could give Bitcoin a bit of a tailwind as long as it lasts. If legacy markets let Bitcoin breathe, sort of speaking, and Bitcoin remains above 80,000, it would likely go much higher. As we can see here in this chart, Bitcoin is having very good momentum. We are in the 5th consecutive green week so far, and yet it is still, in a way, struggling a little bit with that psychological level around 81K, at least at the time of this recording. So similarly, Ether is struggling with same 2.4K level that we have talked about a few times already. So both of these levels we have discussed in our previous 2 episodes. So let's look at the chart. If the momentum persists during this week, going into the end of this week, then a gap up to the mid-80s range, around 85K, is very, very likely for Bitcoin. If we get it and hold 85,000, I dare to say that bull race is on to first 93, 94K, and if it goes well, then afterwards towards 100,000, as you can see here on the chart as well. Taking a closer look at Bitcoin, let's use the TPO charts, time price opportunity charts, to inspect the migration of the value areas since the early February period after the crash. Here it is highlighted for easier visibility. The migration of the value areas since the late January crash shows value initially stabilizing, meaning in the early February, and then subsequent slow migration up higher. So when we zoom in on the current week, as you can see here, we can observe where the current price is spending most of the time while Bitcoin changes hands. Bitcoin, if bullish, has no business closing the daily below 79.5.3K, which is boxed here in orange color. As long as it holds and remains above 80,000 roughly, there is a very good chance of higher prices. Given that it is also trading at its upper channel line in the chart that we saw earlier in purple color, this upper channel line has acted as a resistance over the past 2.5 months. And given that it is currently struggling a little bit with the 80,000 level, it remains to be seen during this week what gives first. Consolidation at a resistant level is, generally speaking, more bullish than bearish, as it indicates supply absorption. So which side gets exhausted first, buyers or sellers? I would say let's find out at the end of this week. The last time we checked the power law channels, Bitcoin's price was sitting at the lowest band, which in hindsight speaking acted as strong support, and with the price recovering some 30% since. So zoomed in, we can see very clearly that it held, of course, but for context, it is useful also to look at some historical monthly seasonality, which gives us some additional context for what to expect in the weeks ahead. So first, for Bitcoin, both the average and median are decently positive, and so far May is in the green, which is the 3rd month in a row. So on average, August and September are, let's say, the worst performing months, with June and July being kind of a mixed bag over the past 10-12 years. For Ether, the monthly seasonality picture looks, let's say, more decent for May, but it looks quite bleak for the second half of the year. And the buying support behind Ether tells a similar story. As a reminder, Tom Lee's BitMine continued its Ether purchases also in April, with 17.5 billion totally invested so far. Still, Ether's price is struggling with the 2.4K level, as we've shown and discussed a few moments ago. So taken together, this data makes me less confident about any sustainable Ether rally over the next few weeks or even months. Comparing the buyers behind Bitcoin and Ether, we can look at something, for example, as MSTR and BlackRock's Spot Ether ETF, as you can see here on the chart. Saylor's MSTR has clearly more strength and is leading the way to the upside, already in the green and above its 200 daily moving average. Yes, you can also make an argument that due to Ether lagging, it presents an opportunity in of itself. But you do as you please. It's your decision, your capital. Ether lagging behind Bitcoin in relative terms is actually a window into the broader state of the entire altcoin market. If Bitcoin is doing well and rallying as it is the case currently at the time of the recording, then the majority of alts will do a little to nothing until Bitcoin is done. Even Ether typically underperforms at first. Some altcoins would see appreciation in USD terms, of course, but their true strength indicator is actually to be found in their BTC ratio. That is the place to look to gauge any relative strength of any altcoins. Just to give you an example, one of the biggest altcoins within the top 10, and without cherry picking, is this one here. As you can see, better said, what you're looking at right now is the Sol BTC price chart. Since mid-September last year, it has lost 50% against Bitcoin. The point is that alts are essentially leveraged Bitcoin and come with a different risk profile. If I'm choosing any altcoin over Bitcoin, I need to consider the potential reward, which should be high enough to compensate for the much higher risk plus the opportunity costs. If that is not the case, then sticking with Bitcoin or just sitting on cash pile is or could be better option. But to put things into context, on a relative basis, the vast majority, if not everything, besides Bitcoin, has gone nowhere over the past 12 months. As you can see here in this chart, others versus BTC. Yes, there are a handful of noteworthy exceptions, as is, of course, always the case. And looking here at the total 2 chart, excluding stablecoins and Bitcoin, despite the notable recovery, the market is still far below its peak from September last year and well below its 200 daily moving average. So the broader crypto markets is retesting its pre-breakout level from November 2024. It is doing it so from below and not from above. So that's a key distinction. It is back at the levels that we saw before the brief bull market ensued following the U.S. presidential election results. The broader TradFi asset markets, excluding crypto, have been recovering and performing very well, leaving crypto markets behind. And any capital rotation into digital assets may not come as soon as some would hope, but it could come nevertheless, of course. Fundamentals are steadily improving, both on the technical development and regulatory fronts. In the event of any capital rotation, quality projects backed by real utility would absorb any incoming risk on capital, or would do it first, meaning the majority of altcoin garbage still floating around would stay ignored and be left to die. I would say rightfully so. One final note before we close. It's an important one for anyone with DeFi exposure, I would say. April saw a sharp rise in DeFi hacks and exploits with almost 30 reported cases by dollar value. April was one of the largest months on record, with losses topping 630 million so far. So this casts a shadow on DeFi's security and reliability in the eyes of institutional investors, I would say, and in a way undermines their confidence to seek exposure to DeFi protocols. One-time audits are a thing of the past, so teams now need real-time security monitoring, which costs, of course, money. And in the current bear market, security spending remains very, very low. Beyond just hurting asset prices, the hacks also expose the weak points in protocol governance models, questioning how decentralized these protocols really are. And it seems to me, I would say maybe rightfully so, that this question mark justifies a more closer look. Decentralized in DeFi was mostly just a marketing slogan, a marketing wording, and from a security perspective, it showed to be an absolute nightmare. AI tools are actively assisting attackers in finding vulnerabilities and executing targeted social engineering attacks. So given that DeFi has grown in complexity, linking more protocols than ever before, which is, I would say, a sign of both maturity and expansion, this has in turn increased the attack surface. Despite the sheer number of attacks that we saw in April, the overall hack volume is still in significant decline. So April was an outlier. That's all for this one. See you next time.